Your portfolio is down on some positions right now. That is not purely bad news. The IRS lets you use those losses to offset your gains, and if you do it right, you can cut your tax bill without actually changing your long-term exposure. It is called tax loss harvesting, and most people either skip it entirely or do it wrong. Today I am going to show you 3 AI prompts that walk you through the whole process step by step. Welcome back to the AI Portfolio. I am Abdul, and every episode I bring you 3 AI prompts you can use as an everyday investor. Quick disclaimer before we start. Nothing in this video is financial or tax advice. Tax rules vary by country, change over time, and your situation is specific to you. Always check with a qualified tax professional before acting on anything you see here. Let us start with the basics. Tax loss harvesting means deliberately selling a position that is sitting at a loss so you can realize that loss on paper. You then use that realized loss to offset capital gains you have taken elsewhere in the same tax year. If your losses exceed your gains, you can deduct up to $3,000 of the remainder against ordinary income and carry anything beyond that forward into future years. The key word is taxable. This strategy only works in a regular brokerage account. It does nothing for you inside a Roth IRA, a traditional IRA, or a 401k, because those accounts are already tax sheltered, and it helps you most if you are in a higher tax bracket, because the savings scale with your marginal rate. Before you run any prompts, be honest about whether harvesting makes sense for you at all. If you're in the 10 or 12% bracket, the math rarely works out once you factor in transaction costs and the drag from future taxes on your replacement position. If you are in the 22% bracket or above and you have realized gains to offset, it starts to make real sense. You also need to be investing in a taxable brokerage account, and you need to be holding positions that have actually declined since you bought them. If your entire portfolio is up, there's nothing to harvest. That sounds obvious. But a lot of people ask their AI about harvesting without checking that basic condition first. Here is prompt 1. Paste your current holdings into the chat: ticker, number of shares, average cost basis, and current price. Then ask, based on these positions, identify which holdings are showing unrealized losses. For each one, calculate the total loss in dollars and as a percentage. Flag any positions where I hold multiple tax lots at different cost bases, and note whether harvesting the highest cost lot only would preserve part of my position. The tax lot detail is what makes this prompt powerful. If you bought a stock in 3 separate purchases, some lots may be profitable while others are not. A good AI response will break that down for you and show you exactly which shares to sell to maximize the loss you can realize without liquidating the entire position. Before we get to prompt 2, you need to understand one rule that kills more harvesting attempts than anything else: the wash sale rule. If you sell a security at a loss and then buy the same security, or a substantially identical one, within 30 days before or after the sale, the IRS disallows the loss entirely. You do not get the deduction. The clock runs 61 days total, 30 days before, the day of the sale, and 30 days after. Substantially identical is where it gets murky. Selling one S&P 500 ETF and buying another that tracks the same index is a gray area many advisors treat as a wash sale. Selling an ETF and buying the underlying index futures is different. This is exactly where prompt 2 comes in. Prompt 2 addresses the replacement problem directly. After you have identified the positions you want to sell, ask, I am planning to harvest a loss on ticker. Suggest 2 or 3 replacement securities that would maintain similar market exposure without triggering a wash sale violation. For each suggestion, Note how it differs from the original holding, different index, different provider, different asset class tilt, and explain why that difference likely avoids the substantially identical standard. What you want to see in the response is a clear rationale, not just a list of tickers. The AI should tell you why each replacement is genuinely different. Use this output as a starting point for your own research, not as a final answer. Confirm the logic with a tax professional before you execute, especially for sector ETFs where differences can be thin. Prompt 3 is the one most people skip, and it is the most important. Harvesting a loss feels like free money, but it is not. You are deferring tax, not eliminating it. Your replacement security has a lower cost basis, which means a larger gain when you eventually sell. Ask, estimate the net tax benefit of harvesting a dollar amount loss on ticker, assuming a X% federal long-term capital gains rate and Y% state rate. Factor in a round-trip transaction cost amount. Also estimate the future tax drag if I hold the replacement security for 5 years and it appreciates by the same amount as the original. That future tax drag number will often surprise you. Harvesting still wins in most scenarios, but by a smaller margin than the raw loss figure suggests. Let me flag the mistakes I see come up most often. First, harvesting without a plan for what you will buy next. If you sit in cash for 31 days to avoid the wash sale window, you might miss a recovery in the position you just sold. Have your replacement ready before you sell. Second, ignoring state taxes. Some states do not conform to federal wash sale rules or treat capital gains differently. Your AI may not know your state rules unless you tell it explicitly. Third, doing this once and forgetting about it. Harvesting works best as a regular practice, quarterly check-ins, or after any significant market drawdown. The investors who benefit most are the ones who build it into their routine, not the ones who scramble at year-end in December. Here is your homework. Open your brokerage account and pull your current positions with cost basis data. Run prompt 1 and find out which positions or which specific tax lots are sitting at a loss. Then check whether any of those losses are large enough to matter given your tax rate. You do not need to act on any of it today. Just know what is there. Next episode, we are covering concentration risk. How to find out if your portfolio is more exposed to a single outcome than you realize, and what to do about it. See you Thursday.